This market is doing something that makes perfectly rational people feel insane. Stocks are sprinting. Bitcoin is climbing again. Risk appetite is coming back in pockets. And yet the ordinary economic experience of the average person still feels strained, expensive, and vaguely threatening. That split is the whole story. Because what we are living through right now is not a normal everything is fine bull market. It is a melt-up style environment, a phase where asset prices can keep levitating even while the underlying emotional reality of the country feels rotten. That is when the game gets dangerous. Not because you should panic, because this is when people start telling themselves stories that are too clean for the mess they are actually standing in. So let us clean it up. The first thing you need to understand is that the Federal Reserve did not just cancel all rate cuts forever. That is not what happened. What happened is more specific and in some ways more useful. On the 29th of April 2026, the Fed held the target range at 3.5% to 3.75%. In its statement in Powell's press conference, it made clear that inflation is still elevated and that the recent spike in global energy prices is a serious complication. In other words, the market did not get the easy dovish rescue some people were hoping for, and the Fed is not eager to loosen policy into an energy-driven inflation pulse. Faysite Fay turn 523,448 search, 0 Fay turn 523,448 search 4 Fay. That matters because a lot of people have been building their whole 2026 story around one comforting assumption. Rates come down, financial conditions ease, everything gets easier. That story is now much weaker than it looked a few months ago. And the reason is not mysterious. It is oil. Oil is still the ugly variable that nobody wants to respect until it starts eating through everything else. People hear AI economy, soft landing, productivity, earnings, and innovation. But beneath every price tag in the real economy is still a giant, dirty, very old truth. Energy runs the system. Trucks, shipping, plastics, fertilizer, manufacturing, packaging, aviation, logistics, all of it leans on energy costs, whether people like it or not. And right now, energy is not behaving politely. By the end of April 2026, Brent had already traded above $120 a barrel and even briefly hit the mid-$1.20s amid the Iran war and Strait of Hormuz disruption fears. Reuters also reported that analysts now see oil around or above $100 for longer, with some warning that if these levels persist, inflation could move back above 4% later in the year. That is not a side story. That is a macro pressure point. Faysite Fay turn 523,448 news. 41 Fay turn 523,448 news. 40 Fay turn 523,448 search. 7 Fay turn 523,448 search. 15 Fay. Now connect that to inflation. March CPI already came in at 3.3% year over year, with energy up 12.5% from a year earlier, and that was before the late April oil panic fully worked its way through the monthly data. So when the Fed says inflation is elevated and energy is complicating the picture, that is not some abstract phrase designed to buy time. It is the real problem standing in the room. Faysite Fay turn 523,448 search. 2 Fay turn 523,448 search. 10 Fay. This is why I want you to stop thinking in headline slogans. No, the Fed did not save the market. No, the inflation fight is not neatly over. No, the macro picture is not clean. And yet, asset prices can still rip higher anyway. That is the part that confuses people. They think a market rally is supposed to require broad emotional comfort. It does not. The stock market is not a poll of how average people feel right now. It is a machine that prices what large pools of capital think tomorrow might look like. That is why Wall Street and Main Street can feel like they are living in different countries. Wall Street looks 12 months ahead. Main Street is paying for groceries today. Wall Street sees policy eventually adapting, earnings holding up, trade frictions easing in places, and liquidity finding a path. Main Street sees rent, gas, insurance, and uncertainty. Those are different lenses, and they can diverge for much longer than most people expect. In fact, that divergence is part of what gives melt-up phases their strange character. Consumer sentiment can feel awful while the market acts as though a brighter future has already been ordered and paid for. Reuters just highlighted exactly this split. Oil above $100, inflation fears rising, and yet equities substantially back above pre-war levels. That is not because markets are moral. It is because markets are forward-looking and emotionally cold. Faysite Fay turn 523,448 search. 11 Fay. Now let us talk about the part that really hurts people, timing. Every time conditions feel obviously terrible, some group of investors convinces itself that now is finally the moment when patience, prudence, and waiting for clarity will be rewarded, and every time conditions feel obviously euphoric, another group convinces itself that this is the easy road to riches and that risk has quietly retired. Both groups are usually wrong in the same way. They are trying to force certainty onto a system built on reflex, fear, anticipation, and narrative shifts that no ordinary person can consistently outguess. This is the part I have learned the hard way. The market often looks safest right before it punishes confidence. It often looks most dangerous right before it launches. That is why the people who sold in the ugly stretches to wait for cleaner signals so often miss the very move they were trying to protect themselves from. And the people who finally feel emotionally safe after the rally tend to arrive precisely when risk starts wearing perfume. That is not a bug. That is how the market operates. Now, let us bring Bitcoin into this, because it helps illustrate the same principle with even more emotional violence. During the worst parts of the recent drawdown, the confident tone was that Bitcoin was finished. The ETF trade was broken institutional. Demand had failed, and this was the end of the fantasy. That is almost always how it sounds near important lows. Then the price starts climbing, the flows stabilize, the narrative changes. Suddenly what looked dead starts looking inevitable again. That is not because the underlying truth changed overnight. It is because markets reprice ahead of emotional permission. The same structure is at work in equities. And this is why I keep coming back to one unglamorous conclusion. You are probably not going to outtime this. You are not going to beat the people sitting closest to the information. You are not going to outmaneuver the fastest desks on earth by doom scrolling for 6 hours and then waiting for a feeling of certainty. What you can do is decide on a level of risk you can actually survive. What you can do is choose allocations you can hold through a real drawdown. What you can do is stay consistent while the environment keeps trying to humiliate anyone who wants too much clarity before acting. That is where most long-term wealth gets built, not in the brilliant prediction, in the disciplined refusal to let every swing in the environment rewrite the plan. Now let me say something about housing, because this is where people keep wanting a clean national answer. And the truth is uglier than that. There is no single housing market. There are many. High rate sensitivity is still real. Affordability is still a mess. Some regions that had the wildest run-ups are now visibly softer, while other supply-constrained areas remain sticky, even if activity is thinner. Mortgage rates remain the choke point, and even if they drift lower eventually, that does not automatically create a giant affordability miracle. Small moves in rates help. They do not erase years of price inflation and household strain. So no, I do not see housing as a clean risk. On confirmation signal, I see it as another example of a market where price, affordability, and psychology are now living on separate planets. And that brings me back to Powell Warsh and the temptation to build a whole cinematic story around personnel. Jerome Powell just chaired the 29th of April meeting. Kevin Warsh is still not in the chair today. Reuters reported this week that his nomination is advancing and his path looks increasingly likely, but that is not the same thing as saying he has already taken over or that one man as arrival instantly creates some easy new rate regime, even if Warsh ultimately takes the seat. The constraints of inflation, oil, debt, labor, and political optics do not vanish. The office changes, the arithmetic remains. Fay-site Fay-turn 523,448 search 5 Fay-turn 523,448 search 9 Fay. That is why I do not want you building your life around central bank fan fiction. The game is harder and simpler than that. Harder because the macro backdrop is genuinely messy. Simpler because the strategy that survives messy backdrops has not changed much. Keep buying, keep allocating, keep enough liquidity that you are not forced into stupid decisions. Do not lever your life around predictions. You cannot verify. Do not sell because you are waiting for the market to hand you emotional certainty. And do not buy aggressively simply because a rally made everyone around you feel temporarily invincible. That is the middle path. It is not exciting. That is one reason it works. Now, does that mean there is no danger here? Of course not. Melt-up phases are dangerous precisely because they can keep rewarding risk, taking longer than seems reasonable, and then punish people who came to believe reason no longer mattered. The point is not that everything is fine. The point is that markets can keep moving higher in an environment that feels completely contradictory right up until the bill arrives, and that bill, when it comes, never sends a calendar invitation. So what do? You stop trying to predict the exact hour of the turn. You accept that Wall Street and Main Street can diverge violently. You accept that oil can keep inflation hotter than people want. You accept that the Fed can stay tighter for longer without stopping the rally immediately. You accept that Bitcoin and stocks can rebound hard even while the emotional environment feels broken. And then, with all of that accepted, you stay the course anyway. Not because certainty exists, because it does not. Because long-term discipline still beats short-term confidence. And because the people who survive these cycles are usually not the ones who guessed every turn. They are the ones who refuse to let every turn guess them.